Welcome to Talk Tickers, where we break down the earnings calls that matter. And today, we are digging into Beam Global, ticker BEEM. Their Q3 2025 earnings call, wow, it was a wild one. We're talking a massive top-line miss, a huge strategic pivot, and a CEO literally calling in from Abu Dhabi at 1:30 in the morning to sell the future. So let's get right into it.
So, the big question hanging over everything is this. Is Beam Global making a really painful but totally necessary pivot toward a profitable future? Or are we just watching a story stock try to talk its way out of a truly disastrous quarter? Management is telling one story, but the numbers, well, they're telling a completely different one.
All right, first things first, let's look at the Q3 scorecard. We're going to jump straight into the headline numbers, and I gotta warn you, they are not pretty. The market was braced for some weakness, but I don't think anyone saw this coming.
Yeah, that's a 50% year-over-year drop in revenue. It came in at just $5.8 million, way down from $11.5 million in the same quarter last year. A 50% haircut is just brutal. There's no other way to put it.
And look, that $5.8 million wasn't just a big drop from last year. It was a 35% miss against what analysts were expecting. That means Wall Street was completely blindsided by just how bad the slowdown was.
And of course, the pain didn't stop at the top line. The GAAP earnings per share came in at negative 28 cents. That's a 3-cent miss compared to the negative 25-cent consensus. And just think, this is a huge swing from a 9-cent profit a year ago. It just shows you how fast things can unravel.
This slide right here really paints the picture of the operational mess. The GAAP gross margin went from a healthy, positive 11% last year all the way down to a negative 1% this quarter. The main reason? Poor fixed overhead absorption. Just think of it this way. Your factory rent is the same whether you build one EV charger or 1,000. When your production numbers fall off a cliff, those fixed costs just absolutely eat you alive.
Okay, so when you post numbers that bad, you better believe management needs a very compelling story. And they came prepared. Their whole narrative is about this strategic pivot that they claim was basically forced on them by things way outside their control.
So management pointed to three main things. First, a big federal order worth over $3 million slipped out of the quarter. They were quick to say it's just delayed, not lost. Second, they're seeing a wider pullback from the U.S. government on electrifying their fleets. And third, some political unrest over in the Balkans held up some of their legacy European orders. The key takeaway they wanted to leave everyone with is that this is all temporary.
But here's where it gets interesting. This isn't just an excuse, it's actually a strategy. Just look at this shift. Year-to-date, non-government revenue has more than doubled as a piece of the pie, from 31% to 67%. And international sales almost doubled. So what does this tell you? It tells you the company is actively trying to get away from relying on these huge, unpredictable U.S. government contracts and shift toward what they hope is more stable commercial and international business.
The turnaround plan really comes down to three things. First, they're going hard on international expansion, especially with a new joint venture in the Middle East that's targeting a, get this, trillion-dollar market. Second, they're diversifying their products away from just car chargers and into things like e-bikes and drones, hopefully building some recurring revenue. And third, they're trying to be disciplined on costs, and they have cut almost $2 million in non-GAAP operating expenses this year.
So, that's the story. It's ambitious, it's forward-looking, it sounds pretty good, right? But what did the market think? Well, it reacted with a huge dose of skepticism. Let's look at the market's verdict in cold, hard numbers.
This was the stock's reaction the day after the earnings call, a move of just 0.5%. After a 50% revenue collapse, the market basically just shrugged and said, yeah, we're not buying the turnaround story, at least not yet.
And to really put that skepticism into context, just zoom out and look at the one-year performance. The clean energy sector, using ICLN as a proxy, is up over 33%. The S&P 500 is up almost 12%, and Beam, it's down over 56%. This isn't just one bad quarter. It's part of a long and painful stretch of underperformance. So what's really holding investors back? Well, it boils down to four big concerns. First, they need cash. The company actually filed to raise more capital on the same day as earnings, which screams potential dilution is coming. Second, there is massive execution risk. This pivot to new markets and products sounds great on a conference call, but it's totally unproven. Third, they're still burning through cash. And finally, the original problem is still there. They're super vulnerable to whatever the U.S. government decides to do on climate spending.
Okay. So that's the setup. You've got a deeply discounted stock with a very high-risk, high-reward story. Let's wrap this up with our official verdict on the stock and then float a plausible trade idea for the brave ones out there.
We're rating this a market perform. Basically, we think the stock will probably trade in line with its peers. Why? Because you have this massive valuation discount on one hand, but it's perfectly balanced by these equally massive, unproven execution risks on the other. The bull case is compelling for sure, but the bear case is just as strong.
Now looking ahead to Q4, we're modeling revenue somewhere between $7 and $9 million. That would be a modest recovery, but it really depends on them converting that $8 million backlog. We still expect them to lose money, probably somewhere between -20 and 25 cents a share. And for the stock price, we see it stuck in a range. The market is firmly in a show-me state, and it's going to take real proof this pivot is working before the stock can break out.
So, is there a trade here? We think there might be. We're calling it the backlog conversion play. Here's how it works. The catalyst you're watching for is a press release, either one that confirms that slipped $3 million federal order is back on the books, or a big new first order from that Middle East venture. If that news hits, you could jump in with a tactical long position. Your target would be a quick 20 to 30% pop as the market gets excited about near-term revenue. But, and this is key, this is a trade, not an investment. The plan is to get in and get out, because all those long-term risks about needing cash and actually executing the plan, they don't disappear with one good announcement.
And as always, a quick reminder, this is not financial advice. Please be sure to make all your investment decisions with the help of a qualified professional.